Have you ever thought about the prices of everything you buy or sell? Who decides those prices? Also, in most cases, why these prices keep changing? It may be the prices of vegetables, grains or spices that you consume on daily basis, electronic gadgets that you buy, your favorite cars, petrol, diesel that you fill for your car, real estate properties that you buy or sell, even the cost of labor, etc., and everything else you can imagine that you buy or sell. No idea? Don't worry. This video will clarify everything you need to know. So let us start. For any buy and sell transaction to happen, we need minimum two parties, a buyer and a seller. Then the buyer must have the cash to buy what he wants, and the seller must have something to sell that the buyer would be interested in buying. Now, in this transaction, let us say the ice cream vendor is selling the ice creams for $1 per piece. The buyer pays $1 for the ice cream, whereas the seller sells the ice cream to the buyer in return to the $1 he has received. Note that the buyer happily paid the $1 for the ice cream. So for him, the value of ice cream is more than $1. He is satisfied with the product. Also, the seller happily sold the ice cream for $1. So for him, the value of $1 is more than what the ice cream actually costed him to produce. Say, for example, it costs only 50 cents for him to make a single piece of ice cream. So the remaining 50 cents was his profit. Great. That was a very simple and straightforward transaction. Let us move forward and consider the same transaction with few more ice cream vendors who newly start their stalls beside the first vendor, and they sell the same kind of ice creams. Given that there is only one potential ice cream buyer at this time and newly introduced ice cream sellers, do you think this will have any effect on the profitability of the first vendor or not? You can pause the video for a moment and think about it. It's okay if you couldn't make any conclusion. Also, great if you thought about it in a right way. In any case, let's check it together. As you can see, there are more ice cream sellers who want to sell their ice creams, but there is only one potential buyer. This will definitely force them to reduce the prices to attract that buyer towards them instead of him going to others. Obviously, they can't go home without selling any ice creams. Thinking through this, the first vendor reduces the price of the ice cream to 80 cents instead of $1. His profit is just 30 cents now, which is obviously less compared to the 50 cents when he was the only seller. Knowing the reduced ice cream price, few more potential ice cream buyers get attracted towards the stall and they buy the ice creams from the first vendor who is selling the ice creams at 80 cents. Seeing only the transactions happening through the first vendor at 80 cents, the other vendors are also forced to sell their ice creams at 80 cents. The accepted rate of ice creams is now 80 cents all over. In other words, the current market rate of the ice cream is 80 cents. With the increasing number of ice cream lovers getting attracted towards these stalls because of lower price, and since only fewer ice creams remaining with the sellers, the ice cream vendors feel confident that all their ice creams will get sold, even if few of the buyers accept to buy at $1, and they decide to increase the price at $1. And buyers too are accepting increased price at $1. That is, the accepted rate of the ice cream is back to $1. In other words, the current market rate of the ice cream is $1. In this whole example, did you notice a key thing that was driving the change of price? Let's find it together. As we saw, the increased number of sellers caused the ice cream price to drop from $1 to 80 cents. but the increased number of buyers than the sellers again caused it to increase back to $1. Here, the increase in the number of sellers indicates more supply of ice creams. Similarly, increase in the number of buyers indicates more demand for ice creams. So, the price change was based on the available supply and demand for ice cream. This is the universal rule applicable to everything we buy or sell. In fact, it is the main model of price determination used in economic theory, demand and supply. So, we now understand that the price of a product is determined by the law of supply and demand. Consumers have a desire to acquire a product, and producers manufacture a supply to meet this demand. The equilibrium market price, or in short, the market price of a good, is the price at which the quantity supplied equals the quantity demanded. To summarize the individual effects of changing supply or demand on the prices, let us consider four simple cases. With demand at constant level, increase in supply leads to decrease in the price of the product. With supply at constant level, increase in demand leads to increase in the price of the product. With demand at constant level, decrease in supply leads to increase in the price of the product. With supply at constant level, decrease in demand leads to decrease in the price of the product. However, in real life scenarios, both supply and demand can be changing at the same time. Here are the possible outcomes in those cases. You can pause the video and try to understand them individually before proceeding on to the next part of the video. The law of demand says that at higher prices, buyers will demand less of an economic good. The law of supply says that at higher prices, sellers will supply more of an economic good. These two laws interact to determine the actual market prices and volume of goods that are traded on a market. So, someone who starts selling a product will set the price based on the cost of production. But depending on how supply and demand emerges for that product, the price of the product will keep changing. For our earlier scenario, if we plot the ice cream price versus time, the chart will look like this. The law of supply and demand is one of the most basic economic laws that ties into almost all economic principles in some way. This is applicable to the price determination of virtually anything that is bought or sold, or in other words, traded. For example, vegetables, products, services, shares or stocks, commodities, currency, etc. Several independent factors can affect the shape of market supply and demand, thereby influencing both the prices and quantities that we observe in markets. Such factors are quality of the product, ease of access to product or geographical location, preferences of consumers, income of the people, seasonal support from nature, new technologies and impact of government decisions on production cost, change in expectation about future prices, natural or man made disasters, etc. To easily relate the supply and demand with the stocks, the good quality stocks of best companies are in much demand and hence the respective prices rise on a longer time frame compared to the one that are not so good quality stocks. For a trader, studying the demand and supply is a must to spot profitable trades. The next time you go to any market, it may be your local vegetable market or your trading terminal for stock market. Observe how the demand and supply is affecting price changes. To make sure that you do not miss out on the similar interesting videos on markets and trading, subscribe to the YouTube channel and press the bell icon.